indicate to the market that the pace of rate cuts may slow down. If the summary of economic projections shows median Fed officials looking for less cuts this year than previously expected by the markets, this would be viewed as hawkish, especially if it was joined by higher median inflation expectations and lower GDP estimates.
On ticker LQDA, Luma, Quebec, Delta Alpha. Shares are seeing a bump in activity. Tim O'Connell with the positive tweet mentions on LQDA.
White House's Levitt says we've moved beyond minerals still.
Macrono, White House with comments says we have, quote, moved beyond minerals deal.
Hey folks, hope everyone out there is doing well. Happy Fednesday to all those who celebrate, who I imagine that's going to include just about everyone out there. I've got Aisha with me here. Aisha, how's it going on this fine Fednesday?
Hi everyone. Can you hear me okay?
Yeah, I can hear you just fine.
Okay, great. Yeah, so we're just about, 13 minutes away now, and should be interesting. I mean, we have the summary of economic projections coming out this time around.
So just
Uh,
as we
Broke
carry
open
on
at
then
2
with
o'clock p.m.
the
Eastern
Fed
Standard
interest
Time,
rates prep.
FOMC.
So if the rate statement is more dovish, underlying increased confidence in inflation return target and satisfaction.
Sorry about that.
Voice news disconnected.
No problem.
Yeah, so we just had a little bit of squawk coming over the wires there. We're going to mute the squawk for now as we get closer to the rate decision. And we'll be covering this live. It's coming up at 2 p.m. Eastern. And really, let's talk a little bit about
And
what we're thinking
dissatisfaction
for
in the strength of the
this
job market. This could
rate
confirm that
decision
the
as
Fed
well.
could
What
go
are you
ahead with
looking
further
for
rate
from
cuts.
the Fed here?
Also, with the
Sure.
commentary then,
So,
Wells Fargo,
but before
they
we talk
expect the
about
FMC
maybe
to
what
remain
we're
on
looking
hold
for, I kind of wanted to recap a
at
little
its
bit
meeting.
about what we saw last time around. So, okay, in December, we saw some changes to the projections. I put out a
So they
video
said,
on Twitter
with the
yesterday.
FMC remained on hold on January 29th meeting, as
If any
strong
of you have
economic
a chance, you
environment
can watch
and
it
policy
just to
uncertainty
understand the
left it
background to it.
operating in a
But
wait-and-see mode.
in
Economic
summary,
activity
what
has
we saw the Fed do
moderated
was
since then.
increase projections for inflation, increase projections for GDP growth as well. So they think the economy is going to be relatively strong, something that Fed Chair Powell keeps saying as well. But they also think that inflation will remain sticky. And on the back of that, they basically decreased the number of rate cuts from 4 to 2, which is quite a drastic one, right? And it came as a surprise to us in December. And they also increased the longer run rate. Now, that's kind of important to me because it makes me wonder whether the Fed is kind of looking at an easing path right now. You know what I mean? So I feel like they are kind of holding, rates stable for a while, and they see that the long run inflation is probably going to be higher than expected, and therefore we would need higher, rates in the economy. So that's a little worrying because most people were hoping for longer run rates to come down to 2.5%. And this is not for today, it's probably for 3 to 5 years out. But as you very well know, capital allocation decisions are often made in 3 to 5 year time horizons. So with rates going up in 3 to 5 or staying higher than they expected in 3 to 5 years time, I think that kind of puts a dampener on capital allocation decisions and spending decisions within the economy. So I think that's something that we should keep an eye on with every summary of economic projections that comes out.
And those summary of economic projections, they come out every quarter. So for folks that aren't familiar with these, what they are and what they mean, we had the last one of these, as Aisha was saying, in December. We're getting the new summary of economic projections today. You probably have heard of it if you've heard of something like the dot plot, right? That's where it gets a lot of juice in the press. We hear a lot about the dot plot, but this also includes the Fed's projections for the economy, for growth, for labor, for unemployment. So it's a pretty important report that the central bank puts out that market watchers pay very close attention to, as do central bank watchers. And that's one of the reasons we're talking about it today. Now, when I'm looking at this, I'm kind of wondering if the Fed's going to come out today and revise that long-term rate projection back down a little bit along with their economic projections. And if that does happen, and again, it is an if, I think that would be the most bullish outcome we could get for markets because I don't think a rate cut's coming today. I believe you're on the same page. I don't think they're making a change to their balance sheet runoff today. I think you're on the same page there. I think the biggest question we have is where are their economic projections and long run rate projections going with this SEP, and how does Powell shape that narrative during the press conference?
Yes, I agree. So I agree on both counts. I do, however, think that there will be questions around quantitative tightening or, the balance sheet runoff. mainly because they did hint at it during their last meeting. So when we looked at the meeting minutes, they did talk about, reducing the pace of QT even further, or perhaps even stopping it sometime this year. Now, most analysts, us included, kind of have September as the target for them to stop QT. We don't know if that's still the target or not, or whether they kind of stop maybe during the summer, so maybe 3 months earlier than what everyone's projecting. And part of the reason for that would be, all the government policies that we are seeing right now. So that's something that I would also kind of keep an eye on, or let's say, wait to hear about during the press conference.
Absolutely. I think those are very important points for folks to consider, because a lot of what the narrative of the Fed is really comes down to Chair Powell. He is the ultimate arbiter of policy. A lot of the other Fed members are just going to instinctually fall into line. So the tone that he sets in this press conference regarding what we see from the summary of economic projections will be important going into this rate decision and SEP release, which is just over 6 minutes away. We do have a market that's been pretty thoroughly de-risked. And one of the things I wrote about in this morning's note and yesterday's note was that it's really hard to get too aggressively bearish into a market where you've seen such fast de-risking. And we're talking about momentum traders like CTAs. We're talking about investors like NAAIM, that survey of managed money. We're talking about positioning aggregates from Deutsche Bank, and just all across the board, we've seen this significant de-risking flow, particularly from the institutional side of participants. And as that's happening, we also saw a lot of fattening on the options chain down in some of the lower strikes of puts on SPX. So the reason I mention all of this, particularly given we're pretty deep in negative gamma here, is that we have this opportunity if, keyword again being if, the Fed comes out and seems to be more dovish than what the consensus is. And remember, watching for those long run projections of rates and the economic outlook, that if we get that impression, a more dovish Fed than what is expected or what we saw in December, that could juice a short-term rally. Does that mean the bottom's in for equities? Not so sure about that. I think uncertainty is the name of the game. It's the game we've been playing since this new administration took office, and even to some degree before that. And as long as that uncertainty is a prevailing factor, I think that will overwhelm whatever short-term impact the Fed has on the markets. What do you think about that, Aisha? Is the uncertainty in the fiscal side and from this administration outweighing some of the market's interest in the monetary side of the ledger?
Oh, absolutely. Absolutely. And I think even before we had the administration take over in January, when we had, right after the administration took over, when we had the January meeting, we saw the Fed actually change their language. So, one other thing that's important to remember is the Fed's statement, right? So the Fed puts out a statement with their decision, and changes to that statement actually matter. And I know many people, get very pedantic about the language, but sometimes that's quite important. For example, in January, when they did put out the statement tracker, they actually removed the wording surrounding inflation. So they had this sentence that started with, inflation has made progress towards the committee's 2% objective. They crossed that out completely, right? And they retained the statement that inflation remains somewhat elevated. So this might seem like a very small change, but actually it's quite a big change. And as soon as that statement actually came out, I remember that the markets took a tumble. It went, much lower, because suddenly now we have inflation front and center once again. And just as you have pointed out, the biggest reason for inflation being in focus is all the fiscal policies and, the trade policies, and the Fed is just foreseeing stickier inflation ahead.
Yeah, I think that's another thing that we need to take into consideration is what if, again, keyword being if, but what if some of this trade policy actually does lead us down to the path of stagflation. It's still early days yet, so we can't say that's the outcome and hang our hat on it, but we have seen some signs that suggest that is at least a growing tail risk to keep track of. And I think that's one of the reasons the Fed would probably be a little bit more timid about going harder on rate cuts. They also don't have the clarity. And maybe this kind of goes full circle to why the fiscal side and the administration's agenda is so important here. Because until we really understand that and have some level of commitment to it, even the Fed can't necessarily act with too much determination. So we see the order book lightening up here ahead of the Fed decision, which is coming to us in 2 minutes at 2 p.m. Eastern time. We'll take some time to parse that decision, especially the summary of economic projections, and then offer our thoughts ahead of the 2:30 press conference, which will also be live streamed right here. But if you are trading this, please take note that because the order book has become so much lighter, that means you're more likely to see whipsaws. So even if you're right on the direction the market ultimately resolves, because of that lack of liquidity, you could really get these erratic moves in both directions. I'm saying that as a word of caution. If you see the order book go that dark and you're trying to trade the tape in the here and now, please be careful. You could get your face ripped off before the order book ultimately gets back to a nominal level of liquidity and before the market ultimately resolves which direction it wants to go. That's one reason these types of events have such exaggerated moves. Another thing that I want to mention is we're about 1 minute away from the decision, is we saw a lot of just-in-time hedging flows yesterday that set the stage for, again, if the Fed comes in a little bit more dovish than the consensus, that can help to juice those hedges and momentum buyers kind of coming back in and adding some liquidity back into the market, which tends to be pretty constructive. So looking at the overall area where there's options interest, the big upside target right now is 5,700 SPX. That's where a lot of the call flow has gone. And then 5,600 SPX for the put flow, where there's a put wall and a vol trigger. So we'll watch that range. It's about a 100-point range that we are likely to trade in based on options positioning and flow right now. I'm going to have the decision in 10 seconds. I'm just going to bring the squawk back on for that.
Voice news disconnected.
All right, so we have that back on. I know it says otherwise, but we do. And we have no cut from this Fed. We have no cut from this Fed. And we do see the median rate forecast coming down from 4.375% to 3.875%. We have the median rate forecast in the long run coming down from, staying at 3%. So we're not getting to that 2.5% level you were talking about, Aisha. We've got the median rate forecast over the next 2 years coming down just a little bit from 3.375% to 3.125%. So it looks like we're seeing a little bit of a softening in the long end rate projections from this Fed, along with what we had talked about. And we just got the dot plot out. I will tweet that out there. Oh, and they did actually announce something on QT. So Fed, beginning in April, will slow the pace of balance sheet runoff. So we just a bit of a recap here, just diving back in and recapping what I posted. The Fed doesn't cut rates, but it reduces some of the longer run rate expectations. The central bank will slow QT starting in April, capping the decline to $5 billion from $25 billion on treasuries. Mortgage-backed securities remaining unchanged at $35 billion. And the rate decision included one dissent from Governor Waller, who supported no change on QT. And they are downwardly revising economic projections here. Unemployment for 2025 rises to 4.4%. So this is kind of coming in line with what I had discussed as the preview. We're having a nominally positive reaction to a Fed that has downwardly revised its economic expectations, including GDP coming down to 1.7% for 2025 from 2.1%, and unemployment projections rising to 4.4%. And also seeing some of those intermediate term rate forecasts coming lower, but the long run rate staying at 3%. They also marked up inflation as a risk. So the biggest takeaway here that I'm seeing, and Aisha's just taking a look at the SEP, so she'll be sharing her thoughts soon here as well. But the biggest takeaway I see from the policy is they're slowing QT pretty significantly. It was already slowed pretty significantly last year. This adds into that slowing, capping the decline in treasuries to $5 billion a month from $25 billion a month. That's a significant reduction. So that does add to the notion that the Fed is becoming just a little bit more concerned about liquidity. You could see also how the reverse repo has dropped to below 200 billion. It's just shy of 200 billion today, but that's another sort of rough aggregate of liquidity that tells us it's getting a little bit lower, a little bit thinner out there as well.
Right, so I'm back. Sorry about that. For some reason, the SCP wasn't loading, but I did post the statement tracker, and Mayhem, as you've rightly pointed out, this is a big decision, changing from 25 to 5 billion. So that's quite a slowdown at a time when they are actually projecting much higher inflation. So if we look at the numbers, what we're seeing is PCE inflation at the headline level has gone up from 2.5 to 2.7. Core PCE has gone up from 2.5 to 2.8. So I think this is quite significant. They are also looking at unemployment going up slightly, and they're seeing much lower numbers in terms of real GDP. So in terms of real GDP, we're seeing it go from 2.1% to 1.7. So still not a recession, but this is definitely stagflation. And in the face of that, they're not changing their rate projections, which is quite interesting. They've left the rate projections at 2 rate cuts for this year and 2 more rate cuts for next year. And then finally, the longer run remains at 3%, as you rightly said. However, I think, you know, maybe slowing down the pace of QT has more to do with this drop in real GDP versus actually helping the government out. What do you think?
Yeah, I think that that's an interesting thought, and I think that the drop in GDP, another part of it that strikes me from that is, this is a Fed that's probably looking at some of the underlying weakness that's building up because we've had a sort of three-peg economy. It's been government spend from larger companies, primarily in the services industry, and spend from more affluent consumers. And we can reasonably say that peg of government spend is coming off a bit. We have a government that wants to, as the Treasury Secretary has said, detox us off of so much fiscal excess. We also have affluent consumers where the top 10% of earners make up almost 50% of consumption. That's a big deal, especially since that top 10% has seen their net worth in equities also drop by about 10%, or maybe more or less, depending on how they're allocated. Then add to that those larger companies and those very aggressive capex numbers and things like AI, where we see efficiency continuing to suggest that maybe, just maybe, those projections are a little aggressive. So if we look at it, every peg in the economic support stool, as it were, is being shaved down. And I think the Fed is aware of that. They've been looking at that in their models, and they're saying, you know what? We're still looking at lower growth. We're not looking at negative growth, as the Atlanta Fed GDP Now model suggested, in part due to some of the scope of gold imports potentially, but we are looking at subdued growth, and we are looking at upside risks to inflation, which again kind of speaks to the idea of what we've been talking about with our Macrovisor 2025 outlook, that stagflation is a bit of a risk. But it also, I think, speaks to a Fed that is starting to realize that they're going to have to resume their cutting cycle possibly as early as June. And I think that's when the next SEP comes out as well. What do you think?
So, yes, I do think that they will have to cut in the summer, so June, perhaps July. Um, I don't think they can hold off for longer than that with the way things are going. Now, very interesting thing that you pointed out about, the GDP drop as suggested by Atlanta Fed. Yes, I think this quarter's GDP drop that the Atlanta Fed is projecting is a bit of an anomaly. Now, I read a few. So, as you said, some of it has to do with gold imports. Sorry, and we don't know, or at least I have not been able to find out who imported this gold. So, if this gold was imported as a financial transaction or imported by the by the government, then it would count towards being a financial transaction and therefore would not directly impact the GDP growth rate. So then we'll probably see a more realistic picture of real GDP. However, if it's actually imported, and it's probably not the case that it's imported for manufacturing or for using, then that will skew the GDP quite a bit, and we actually won't be able to see the real picture with the headline number. So we'll have to dig deeper into what's happening to figure out what's actually slowing and what's not. So the biggest thing to note here is government spending will be slowing, right? We know that. And that's what everybody's worried about, that this slowdown in government spending is going to cause a recession. And we also know, and we've talked about this a lot, that government spending is what was driving GDP growth, either directly or indirectly over the last 2 years. So indirectly meaning through stimulus packages that, or grants or whatever you want to say, that was given out to companies and to consumers for their spending. Now, what will be key is, so we know government spending is coming down. So what will be key is to look at consumer spending and private spending, right? So company spending. So if company spending, and I think we will see a drop in company spending. So if company spending is coming down, that's where we're going to see the hit, because Secretary Besant keeps on saying that they want a shift from government spending to private spending. However, with the uncertainty that they are creating in the economy, again, as I said, most of these people cannot decide. They can't decide whether they should or shouldn't spend, and what's the right place to spend, and how much we should be spending. So so this is how the uncertainty sort of weighs on the economy, and that sort of has, a spiraling effect, right? Because the situation is uncertain, people hold off on spending decisions, and that kind of lowers the GDP growth even more. So one thing leads to another. Now, can people see past this uncertainty and continue to spend? I don't know. Quite likely not. I mean, if we're thinking about it from our own perspective as an individual, I would probably think, okay, let's wait and see what happens. And companies may think the same thing, which is why we're not even seeing a lot of upward revisions in earnings either. So all this time we've been saying, okay, the Mag 7 earnings are going to be revised lower. We know that it's slowing down. We know the growth there is slowing down. But it's not just the Mag 7, it's the 493 as well, where we're not seeing these upward revisions in earnings, and it was supposed to be their time to shine. So I think what I'm trying to say here is, whether it's an actual slowdown or it's a slowdown because people perceive uncertainty, the end result is the same. So this GDP number may not show it, but going forward, I think we are going to see that slowdown in GDP growth for all the reasons I've just discussed.
And it's a natural slowdown because a lot of the elements that have been supporting this growth have been basically built on borrowed time or a feverish rally in risk assets, neither of which are really sustainable. And in fact, we're running into some of the mathematical limitations of that fiscal largesse. And then on the other side, that markdown in risk asset prices is diminishing wealth effects, so that higher tier of consumers are likely to pull back. And then that big, sort of projection of AI related capex spend, that's the big uncertainty right now. But I still imagine, as I talked to Jason Burrick on that interview in January about this, that I expect those to be pulled back too. So if the three primary pegs of projected spend are coming down, we do have to kind of, batten down the hatches for a weaker economy. And this is a Fed that seemed pretty reticent about cutting again until it saw signs of exactly that outcome. That the economy, the downside risks were growing and were in greater amounts than the risks, to the upside in inflation. So it seems like the Fed is saying inflation's still a risk, but we're a little more worried about the economy now. And I think that makes sense with everything we've been talking about and researching in our own work. We're seeing the same. That yes, there are signs that inflation is being tamed. It's still sticky, but it certainly doesn't enjoy the same sort of upward velocity that we used to see. But on the other side of it, as we've discussed, the economy does appear to be at risk. And with that, so too do some of these prevailing earnings trends that have provided the juice for this concentrated upward rally in the Mag 7. Obviously, you can discount stocks like Tesla because they trade inverse to their fundamentals until recently. You could also discount stocks like Apple, which really haven't had impressive earnings growth for a very long time. But when you look at the core, the Googles, the Microsofts, the Amazons, the Metas, the Nvidias, those are the ones that we need to watch much more carefully from this point forward, because that's really where there's a greater concentration of risk, not only in how the market's weighted, and how big these stocks are in the S&P and the NASDAQ in those market-weighted indices, but also in terms of how much of this rally last year and the year before was on the back of this segment. And on the other side of it, we've seen this rotation into lower risk stocks, value stocks, dividend paying defensive stocks, healthcare, utilities, consumer defensives, that suggests this is a market that's also rotating away from the high flyers and with the broader trend battening down the hatches, rotating into defensives. And if you think about it from the perspective of a money manager, they're not like us retail. Retail, we could just sell everything, go to cash if we want to. I'm not saying anyone necessarily should, but you have that option. If you're a long only fund manager, you don't have that option. You're pretty much limited to having like 90 to 95% of your money in equities at any given time. Depending on your prospectus, it may even be 100%. And if that's ending up that sort of is your investment prerogative, that means that you don't have the opportunity to liquidate your portfolio if you see a big risk on the horizon. All you can do is rotate into safer places where you think you may lose less money. And that's the sort of prevailing flow we've seen as well, this de-risking. It means we can get a reflexive bounce here, and we're seeing that in reaction to the Fed. I'm actually grinding right up to a key major pivot here around 57.15. That's an area where I expect we'll see some resistance. We see some liquidity building up overhead there as well. But at the end of the day, I wouldn't be too surprised to have this reflexive bounce continue, because we've had this exhaustive selling and this big rotation that leaves these stocks in trading opportunity areas. Does that mean that it's time to get long with both hands all the things that used to work that aren't working anymore because their prevailing narratives and earnings trends may be undermined here? Question kind of answers itself, doesn't it? Probably not. But is it still time to continue buying dips in things like high dividend stocks and defensive stocks and value stocks? I think it does. The relative strength trends, the rotational trends there are still worth watching. And if we continue to get these shakeout events, I still am a buyer of those types of stocks in this environment, because if, again, the most of the money is in that long only world, and those long only managers often just have to rotate. They can't just get out of risk. So for now, in the earlier stages of a de-risking regime, they tend to be the beneficiaries. And for folks that are looking for a better safe haven than that, Treasury bills look quite attractive too.
So I really like what you just said, because, and I know maybe we're being a little cautious here, but we are seeing a major rotation happening. So I think, I can't remember, but I think like maybe 2 weeks ago, I even posted a couple of these charts from stock charts, which show us that the top 4 sectors were at the time very defensive sectors, right? Like the very boring sectors. And those of you who've known me long enough know that I really like these very, very boring sectors. But I think their time is coming now. So I really like what you said in terms of, buying the dip, but buying the dip in things where, which will work in these environments, not reflexively buying the dip in NVIDIA. We saw that very much on Friday as well. So if you remember on Friday, when we had this huge rally, and I was half expecting that, I'm going to see all the tech stocks, all in green. And the Mag 7 was actually lagging, whereas I think the number 1 sector was probably materials for a while. I don't know.
Yeah.
I mean, so it's super surprising to me to see materials even in the top 3, let alone the first sector in the ranking. So interesting changes happening in the market. And, playing defensive, I know I'm a little cautious, but playing defensive is never a bad thing. It's better not to lose money than to make a lot of money.
Yeah, absolutely. And I think that is a mantra that more and more is going to be adopted after we see what a real market regime shift looks like, and how many people get carried out on stretchers trying to buy the dip with leverage on things that were working but aren't working. So they might seem like they're getting cheaper and cheaper. But if you were to look at their valuations, you might say, boy, in the wrong type of environment, these things could get a whole lot cheaper. And we don't need to go back further than, say, 2022 to see what crowded growth stocks do in a risk-off regime. they tend to perform the worst. And so that's the other reason that we've been talking about this idea of going to these more defensive places, or even looking at pair trades like long RSP, short SPY, long QQQE, short QQQ, long SPHD, short SPHB. That's high dividend, low vol versus high beta. All those trades have worked this year primarily because of that rotation. And I know that not everyone wants to run a pair trade. So the other idea for those longer term investors out there, or long only swing traders, is looking at those rotations, especially into something like SPHD, that high dividend, low volatility ETF. Because if you look at that chart, and I'm just going to bring it up for folks. We've got just about 7 minutes before the Fed presser. I'm just going to bring this up to show you all, because I think it's such an interesting chart. So let me put this on the broadcast screen. This is SPHD. And you could see the market overall this year has been grinding lower. In fact, it's in correction, or it had been just up till maybe this week. SPHD has been a bit volatile, but it's grinding higher in a risk-off regime. And often when you have this presumption that the Fed's going to continue cutting, and you have this worry about earnings in the economy, and you see risk coming out of high beta and growth, it rotates into parts of the market like this SPHD. And if you look at over a longer time frame, even going back to October 2023, it's just been this kind of up and away chart that still has very strong upward momentum to it. So this is one of the reasons there's nothing wrong with just buying winners in this environment. And in this environment, winners are few and far between, so they're easy to find. I just posted a heat map to Twitter as well about where this rotation's happened year to date. You can see it in the S&P rotating away from the popular places, rotating into, like you were describing, Aisha, kind of the more boring, safer parts of the market. But there's nothing wrong with that. In fact, if anything, it's healthy. And one thing you'll note is often these rotations happen during risk-off regimes. Whatever the rotation is, tends to happen during sell downs more than rallies. All right, I'm going to bring up the Fed conference, so you'll hear some annoying music for a second as I prepare to mute it, and we're just going to put that over there to get it ready for Chair Powell to come out and share his thoughts. We've been wanting him to come out and play a wicked blues guitar solo for so long. I don't know that it'll ever happen, but it would be so amazing if it did.
Maybe once he steps down as chair.
I would be all for it. In fact, even if they made that like a pay-per-view event, it would just be so funny. You'd have to watch it. You couldn't not watch that. All right, so we have the press conference coming up in just about 4.5 minutes, and we will have it live on screen here as well. All right, so the big question on everyone's mind, Aisha, after all that we've addressed here, is what color tie is Jerome Powell going to wear today? I'm going to go with the sure bet. I'm going to go with purple. It's been on a trend.
Yeah, and sometimes I wonder whether he has just the one tie, but then I'm sure he has plenty of purple ties. And from what I understand, he actually wears pretty fancy ties as well. I think one of them was an Hermes, if I'm not mistaken. So the man has taste. We'll give him that. I mean, he was a lawyer after all. I don't know. Let's see if he changes things up.
Yeah, it'll be interesting. Sorry, go ahead.
Like, I can't even remember if he wears any other color.
It's been a while, but I know I've seen some other colors from him in the
Yellow,
past.
I think.
Yeah, I think he's had yellow. I think he's had blue. I think he's had maybe a variety of gray. I feel like he has probably one of the most impressive tie collections in the DC area, but for some reason he's just rocking that purple a lot more than anything else. I don't know if that's him trying to say, look, I'm neutral. I'm wearing the colors of the Crips and the Bloods put together. So I'm just a neutral arbiter here. I don't want anything to do with these gang wars in DC. I mean, I don't know what it is, but it does seem to be his favorite color.
Okay, I just did an image search, and the first 20 images all show him wearing a purple tie. or some variation
That's
thereof.
really funny.
Okay, so I'm going to go out on a limb and say it's not going to be purple.
Okay, so you're going to go with the outlier here. So I'm going to give you 5-1 odds on that. We'll just bet a friendly dollar on that one. So I win $1 if he wears purple. You win 5 if he wears any other color. That'll be fun. Let's see how this goes. And press conference is starting in just about 2 minutes here, folks. Market tends to react quite a bit to the big man speaking. So be nimble if you're trading this tape, because there's basically high frequency natural language algos that are parsing everything he says and often inferring incorrectly. So then their handlers have to come in and undo some of the trades they do. So you get a lot of messiness in this type of tape. And it's not a super liquid tape. You're in contract roll week. You've got options expiry coming up. So there's just all kinds of different flows happening behind the scenes that aren't necessarily liquidity supportive for good quality price discovery. So that is to say, expect a volatile tape while Powell is speaking because of all that's been mentioned. All right, folks, we're going to switch over to the press conference audio, so prepare for some unfortunate elevator music before the event kicks off. I'll rejoin you after that, and stay tuned. It should be an interesting bit of discussion with some potential fireworks in market price discovery.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Colby. Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully. Basically, every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this: you do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens some higher inflation over the next year, must be related to tariffs. We know from the surveys. But if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros of the Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms. Can you say that today, that we have that price stability, that households and businesses are ignoring price growth? When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low 2s in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at they wrote down meaningful decline in growth. From 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature of has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment, because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other? In
labor and inflation, just across the economy. Have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers just, they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during the
Because
pandemic.
you could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course, we're well aware of that. And, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
You know, so we have two goals, right? We have maximum employment and price stability, and we have to balance those. And you know, there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging you know, situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal, and then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecast that really shows significant problems like that.
Well, just to follow up, yesterday the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
You know, there's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months, a 1 in 4 chance of a recession. So the question is whether whether this current situation, those possibilities are elevated. I will say this. We don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, you know, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer, and have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. You know, we look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but you know, nonetheless we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that. And, we will use our tools to foster achievement of our goals to the best we can. And of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories, which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know in a couple of months. We'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal? What that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Kelly.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. They're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have 4.1% unemployment. We've got 2% growth. And it's a pretty good economy, but people are unhappy because of the price level. And we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is really, there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify. You were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah, so in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful, rundown of the balance sheet. Again, the second time that we've slowed the pace. And we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire. Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much, I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well-anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, there's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down, they tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Neil.
Chair Powell, Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Here's a quick QT question. Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because, we want to stop runoff in net at some point. We haven't made any decisions about that. But, we want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the SEP mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I think that's well positioned. forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed the line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember, but we're past that. Beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market, the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the twos, with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
You know, it's not appropriate for me to speculate on political ideas or fiscal policy for that matter. So I'm gonna pass on that one. Thank you.
Daniel.
Hi, Chair Powell. Daniel Avis from Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens? It will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell. Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. Slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why pretty strong support. I just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
Folks, that wraps up the Federal Reserve's press conference starring the one and only Jerome Powell, chair of the Federal Reserve. I thought overall he's doing his best to resist outright saying, yes, we're definitely going to cut over the summer or fall. But at the same time, not really pushing too heavily against it, basically just countering with, well, the economy's strong enough that we can take our time to make that decision a formal one. Meanwhile, you see the summary of economic projections downwardly revising growth pretty materially and upwardly revising inflation expectations. So that does give you a sense that we do still have some of those stagflationary risks, a slowing economy and potentially sticky inflation embedded here. Nevertheless, the Fed reduced the run rate of QT on treasuries from $25 billion to a cap of $5 billion a month. That's a huge reduction. And that's one reason we had that initially bullish reaction. Got right up to the level I was talking about just before lunch on the Traderade Discord, that 5,700, 5,710 SPX level. where we saw the abundance of call activity and some pretty key options exposure as well. That was the easy money in this move. Now we're starting to see some really big offers appearing overhead. You can see that just over here at 57.80, 57.70, about 1,000 contracts on offer around each price level, and some passive sellers starting to hit the tape as well. There was that 1,000 contract sale just earlier, and then we're starting to see some open orders coming in, 325 contracts sold and 2 orders so far. So the easier part of that upward move likely over with here. I think we could probably chop sideways to lower for the end of the day. We had that sort of vol compression event into the Fed, a lot of the late day hedging and early day hedging yesterday that was occurring that really helped to pull prices lower for part of the day. That was unwound. And if you think about what that means, if you have folks coming in and taking short dated hedges, and then they're getting whatever premium back they can by selling those hedges into and after the event volatility catalyst that was the Fed rate decision and the press conference, respectively, that's liquidity positive. That's one reason we had that measured move right up to those price targets, because those were the easiest magnetic levels to potentially get into and then reflected lower from. So for now, I think the easiest part of the move in reaction to the Fed today is over. Now we got to watch the tape over the next several trading days. Remember, this also includes options expiration. So be careful trading this tape out there. A lot of the probabilistic outcomes we may be accustomed to kind of go out the window when the biggest market in the world, the S&P options complex, is rolling so much exposure. Add to that futures contracts, mostly done, but still rolling that exposure as well. It can make this a more volatile tape, but also one where the price action doesn't necessarily comport to what our expectations may be based on technicals, flow, positioning, etc. So thank you all for tuning in to this Fednesday stream. I think it was a lot of fun. We got the move we were looking for from the more dovish Fed. Fed came in even more dovish than I expected them to be, and the market celebrated, getting right up to that 57.10 and rejecting a bit lower into the afternoon. Remember also, the last half hour of trade tends to be very high volume, higher volatility. So if you are still trading this thing, consider downsizing, widening stops if you don't want to get blown out or wicked out of those positions. So thanks again, everyone, for tuning in. I'll catch you soon.